Silver investors, stop watching the candle for a second. Stop arguing in the comments about whether we're going to 90 or back to 70, because this time window is not about the next number on your screen. It's about the next 5 days on the calendar. There is a structural event building inside the COMEX system right now where the math does not balance. Roughly 125 million ounces of potential delivery demand, roughly 80 million ounces of registered deliverable silver projected to be available. 5 days to first notice. The countdown is live. This is financial warfare education, not financial advice. I don't sell you coins. I don't run a fund. I don't take your money. Anyone using my name to do any of that is a criminal. Verify everything, your decisions, your responsibility. Let's walk through exactly what this 125 vs 80 squeeze really is, what the dates mean, and how you, as a serious silver holder, should think about it. Segment 1. Price is the symptom. Delivery math is the disease. As of Sunday, February 22nd, 2026, here's where we stand. Silver just closed Friday at $84.52 on the bid. That's a 7.77% move in a single session, roughly a 25% rally in 11 days off the manipulated low near 64.80. Gold closed strong as well, confirming a metals-wide acceleration. Most people are asking, is it going higher? Is it going to pull back? Wrong question for this week. The right question is, where is the physical silver? Not the promise, not the line item. The actual warehouse-certified COMEX registered metal that can legally settle a March futures contract. Because in 5 days, a contractual deadline hits where somebody has to stop playing paper games and answer that question with real ounces, real cash, or a credibility blow that will take years to recover from. Segment 2, the COMEX contract in plain English. You cannot understand this squeeze without understanding the basic plumbing. A March COMEX silver contract is a simple legal promise. The long buys the right to 5,000 troy ounces of silver for March delivery. The short sells that promise and commits to deliver 5,000 ounces if the long stands for delivery. At Friday's close, each contract is roughly $422,000 worth of metal. 2 types of shorts live in that system. Covered shorts, they either have the metal in a COMEX-approved warehouse already registered, or they have strong locked-in access to it. If they're called, they can perform. The metal is real, naked shorts. They do not have the silver. They sold a promise and are betting that price will fall before delivery so they can buy back cheaper, or they'll be able to source the metal from somewhere else before the deadline. Under normal conditions, this just-in-time silver game can work. Plenty of registered inventory, plenty of eligible that can be flipped to registered, plenty of longs who never want metal anyway. They just roll or cash settle. We are not in normal conditions. Segment 3, the 239 versus 88 million ounce problem. Let's put the hard numbers on the table. As of Friday, Feb 20th, March open interest, 47,147 contracts. Each contract, 5,000 ounces. That's 239 million ounces of theoretical delivery demand. Registered silver in COMEX warehouses, roughly 88 million ounces today, on trend to about 80 million by March 2nd if the current drain continues. So right now you have 239 million ounces potentially demanding delivery, 88 million ounces legally registered and available. That's about a 2.7.1 ratio, nearly 3 ounces promised for every 1 ounce sitting there. Now yes, open interest always falls into first notice. Not every long stands for delivery. Most don't. They close or roll. But here's what's different this time. Registered inventory has been cut in half in about 5 months, from 170 million ounces in October to 88 million today. In just the last 4 weeks, around 90 million ounces have left the COMEX warehouse system. SLV has drained around 45 million ounces this month, including some drawn directly from COMEX eligible piles, shrinking the pool that could be converted to registered. You have less metal than last year, more stress than last year, more committed open interest than normal this close to first notice. If current trends continue, the projection looks like this. Registered by March 2nd, 180 million ounces. March open interest after the last weak hands exit. 125 million ounces still standing. That's your 125 versus 80. Roughly 45 million ounces of demand with no obvious metal behind it. Segment 4, why the remaining longs are scarier than the number. Now zoom in on one detail most people skip. What kind of capital is still in this March contract? 3 weeks ago, March open interest implied about 425 million ounces of paper demand. Today, that's down to 239 million ounces. So roughly 200 million ounces worth of contracts have already closed, rolled, or been forced out. Those were the tourists, the funds that couldn't handle volatility, the speculators who didn't want to post more margin, the weak conviction longs. On the way here, the CME has pulled its main weapon 6 times. Margin per contract went from about $22,000 to roughly $74,000, more than tripled in 4 months. Percentage of contract value jumped in steps. 9%, 11%, 15%, 18%. each hike squeezing out undercapitalized longs. Who's left standing on the long side after 6 hikes and a 25% surge in price? Industrial users, deep-pocketed funds, players who want metal, not just price exposure. These are not the people who flinch at a 5% candle. They have survived margin hikes, survived a malicious smash down to 64 driven by a now sanctioned Shanghai operator, watched price rip back 25% while most of the weak side got shaken out. This is what real short covering looks like, not one headline, not one tweet. A grinding urgent bid as naked shorts decide buying back at higher prices now is less deadly than facing delivery later. Friday's 7.77% day, that's the tape telling you. The covering is accelerating. Segment 5. The 3 dates that actually matter. Your emotions care about every tick. The mechanism cares about 3 dates. Thursday, Feb 26, last clean exit date, position day. Friday, Feb 27, first notice day. Monday, March 2nd, first delivery day. Let's break them down. 1. Thursday, Feb 26, last door for tourists. This is the last day for any long who doesn't really want metal to get out cleanly. After Thursday's close, clearing firms treat any remaining long as someone prepared to take delivery of 5,000 ounces, pay the full contract value, and handle physical logistics. If you're a pure price speculator, a fund just riding momentum, a trader who never planned to pay $422,000 per contract, you must be out by Thursday. Every long still holding into Friday morning has basically signed, I am willing to become the actual owner of 5,000 ounces. Tourists leave before Thursday. The real players stay. 2. Friday, Feb 27. First notice day. This is when the mechanism turns on. Shorts can now issue a delivery notice. The exchange assigns that notice to a long. The long must accept. No negotiation on timing. Key asymmetry. The short chooses when to notice. The long can't call the exchange and say, I want my bars right now. Longs are passive. Shorts decide when to pull the trigger. If you're a naked short on Friday without metal, your choice is compressed to 2. Buy back at whatever price the market demands. Attempt to source metal into a draining system and hope it arrives in time. There is no third door labeled wait and see. 3. Monday, March 2nd, first delivery date. This is when metal actually changes hands on paper. Short transfers a vault warrant for 5,000 ounces in a COMEX approved depository. Long wires the full cash value. Title moves. The bars may physically stay in the warehouse for a bit, but they no longer belong to the old owner. And if that new owner is an industrial user, solar producer, electronics manufacturer, defense contractor, they're not holding that warrant for fun. They're going to withdraw metal over time. Every withdrawal from registered inventory lowers the available pool, tightens the next delivery month. Makes May's 56,000 contracts, 280 million ounces potential, scarier given weaker starting inventory. March is Act 1, May is already loading up for Act 2. Segment 6, the COMEX, can't default, but can do something uglier. The article and transcript make one legal point very clear. COMEX is structured as a cash settlement exchange. Technically, it doesn't default in the bankrupt sense if it runs out of metal. It can set a cash settlement price instead of delivering physical, pay you dollars, not ounces. Legally, that's allowed. Functionally, that's a credibility event of the highest order. If that happens, what it really means is the price on your screen is no longer a clean reflection of physical supply and demand. It's the byproduct of an institution that ran out of metal and decided to preserve itself by printing cash instead of delivering bars. That's not a collapse in a lawyer's definition. That's a collapse in trust. If the world realizes COMEX is a cash-only casino when things get tight, then the COMEX spot becomes a suggestion, not a reference. The question for this week is not, will COMEX default? The question is, how close does this delivery cycle take us toward a forced cash settlement or visible rule changes? Because either one is a signal that the Western paper price has detached from the physical market. True price discovery is happening somewhere else. Shanghai spreads, local premiums, off-exchange deals. Segment 7. What to watch in real time as this unfolds. If you want to actually understand the squeeze instead of just watching candles, here's your checklist from now to Friday. Registered inventory today. You're at 88 million ounces. Trend. Down toward 80 million by March 2nd if the drain continues. If it keeps falling, shorts are losing the supply race. If it suddenly jumps, someone is scrambling to bring metal in to plug holes. Either way, it's a signal. Open interest in March today, 239 million ounces worth. Watch how fast it declines as we approach Thursday. If it collapses toward 120 million, many longs are tapping out. Event more manageable. If it stays high, say above 150 million, into Thursday, committed longs are holding, naked shorts are in deep trouble. The slope of that line is the story. Any 7th margin increase. After 6 hikes and a 25% rally, a 7th would not be routine. It would be a neon sign that the exchange is alarmed by persistent open interest and is throwing its last primary lever even harder. Rule change announcements. Anything tweaking contract structure, new limits on positions or delivery terms. That's not noise. That's a message. The mechanism is under stress. Price behavior versus OI, Friday close, 84.52. If silver accelerates through 90 while open interest stays elevated going into Thursday, that's aggressive short covering into a structural bottleneck. If price stalls or drifts with OI collapsing, the stress is being bled off more gently. This week, you don't watch memes. You watch inventory, open interest, margin, rules, and how price reacts to all four. Segment 8. What this means if you hold physical versus paper. Now the part that actually matters to your life. If you hold physical silver, you are holding the one asset everyone in this drama needs. Longs, to justify taking delivery. Shorts, to fulfill obligations. Industrial users, to keep production running. COMEX, to maintain the appearance of a functioning price mechanism. You already have what they're fighting over. You're not exposed to margin hikes, forced liquidation, a cash settlement that pays you in rapidly debasing dollars instead of ounces. Your biggest decisions this week are, do I add if a flush punishes leveraged paper? Do I sell any if a panic spike gives me a life-changing multiple? But you are not in the arena where naked shorts and exchange operators are trying to survive the next 5 days. If you hold primarily paper silver, SLV, futures, CFDs, oversized leveraged positions, you're plugged directly into margin policy, rule changes, potential cash settlements, the risk that the price you see is not the price at which you can actually get bars. This doesn't mean you panic. It means you know your exposure, know your broker's rules, know what you will do if any of the signals we just listed flash red. Segment 9. How not to blow yourself up in a historic week. This is the week where people who have been waiting for the big move for years finally get it, and then manage to ruin it in 5 days. Avoid that. Do not go all in on leverage because this is the one. Anchor emotionally on any intraday high. The market doesn't care what price you screenshotted. Confuse being early to a narrative with being bulletproof to volatility. Do. Decide your maximum acceptable drawdown before the chaos. Decide your profit-taking ladder if we see an explosive move. At what levels you will trim a % of your tactical exposure. Decide whether you're a stacker or a trader this week. If you try to be both, you'll do each badly. Remember, this is not the last month silver will ever trade. This is, however, one of the clearest structural stress tests for the COMEX system you will see in years. You don't have to catch every cent of it. You just have to get through it, intact, in control, with more ounces or more realized profit than you had going in, not less. Segment 10, where this countdown leaves you. So here's the situation. As of today, registered COMEX silver has fallen from 170 million to about 88 million ounces in 5 months. Roughly 90 million of those ounces left in just the last 4 weeks. March open interest implies 239 million ounces of potential delivery, with 125 million likely to still be standing if trends hold into first notice. The longs left after 6 margin hikes are the most committed, best capitalized, most metal-focused players in this cycle. Price has already moved 25% in 11 days, with a 7.77% spike on Friday that screams short covering under time pressure. First notice is 5 days away. First delivery is March 2nd. The fuse is short. The powder charge is unknown. If you hold physical, you're in the one seat everyone envies but cannot admit. If you hold paper, you're standing in the splash zone of a mechanical stress test. You've been watching John AG here, and I'm OG John AG. If this helped you see beyond the 5-minute chart and actually understand why 125 million ounces of demand versus 80 million ounces of registered supply is not just a headline but a structural x-ray of the silver market, hit like, so this doesn't get buried, subscribe with all notifications on, and drop a comment. Watching the numbers. If you'll be following inventory, open interest, margin, and rules this week, or holding the metal, if your main response to this countdown is to sit tight on the one thing this whole system needs to keep functioning, because on this channel we don't just cheer for squeezes, we study the mechanism, we respect the math, and we position so that when the system runs out of easy answers, we're not the ones left holding only promises.